Sunil Singhania is Chief Investment Officer, Equity Investments at Reliance Mutual Fund. He's joining us right now. Sunil, great having you with us here. First up, let me wish you a very happy Diwali from everyone here at NDTV. And my question to you really, Sunil, is how's the year been? Because last Diwali, when we chatted, there was great optimism. Some of that optimism along the way kind of just withered away. And it has really, for stocks, gotten very challenging over the last 2 or 3 months now. So just summarize it for us. How has it been for you as a veteran investor and for your funds, etc. as well?
Thanks a lot for having me at the outset. On my behalf and on behalf of Reliance Mutual Fund, happy Diwali to all the viewers of NDTV Profit. May the next year be a very vibrant and wealthy year. Obviously, the last Diwali started with a lot of optimism. The markets were doing very well. We started the first half of the somewhat very optimistically. However, the last 2-3 months have been very challenging, both on the international front, more so on the domestic front. However, I think overall it has been a satisfying year for us in terms of outperformance vis-a-vis the Nifty. However, obviously the Nifty could have done better. So hopefully the new Samvat year will make good for the little bit of lesser return which was made in the last 1 year. So yes, challenging times, but we look forward with optimism.
Sunil, given how, especially now, the near-term outlook has become challenging, as one of the largest equity fund managers in the country, are you expecting slightly outsized returns, meaningfully better returns as compared to the index, or you think not just you, but generally equity investors will do just about, good equity investors will do just about what the index does over the next, say, 6-12 months?
See, one is I don't know the definition of outsized returns, but if you take the overall scenario and with interest rates also falling, FD rates falling to 7%, negative returns in real estate and gold as an asset class, I think equity returns with mid-teen kind of returns expected, I think seems to be a very attractive asset class, specifically on a post-tax basis. Going forward, whether the index will move that much or whether there will be pockets which would do better. I think in a growing economy like India, where there are so many listed companies, entrepreneur-driven companies, new segments, new themes coming up, there is definitely a potential of making higher returns outside of index. So I think from our perspective, we are looking at both the index doing well, but yes, the broader markets may be doing a little bit better than the index.
Sunil, stay on with us. My colleague Hina also joining in, and she's got a few questions for you. Hina, go on.
Thanks, Prashant. Sunil, I now wanted to get more sector specific. Firstly, let's talk about the pharma space in particular. What's your view on the huge pharma setback that we've seen in the recent time?
See, very clearly, pharma was one sector where everything was working well. There were earnings surprises on the upside. The sector was immune from what was happening domestically in terms of challenges of growth. Currency was in its favor because rupee had depreciated a bit. And as I said, there was an earnings surprise continuously coming up. As a result, a lot of stocks, started trading at higher than fair valuation. And therefore, a small setback in terms of negative news flow causes sharp reaction. So I think from our perspective, companies which had moved up sharply based on what was happening in terms of outperformance over the last couple of years in terms of profit, they are coming back to reasonable valuation. So I think it was a case of overvaluation coming to fair valuation. At the same time, what is happening on the US FDA front and the regulatory front is clearly pointing to the fact that we have to be braced up in terms of the sector of increased scrutiny, and obviously, therefore, it becomes very, very important that we stick with companies who have a much cleaner record in terms of facing this regulatory challenges. But as a sector, I think it's a great sector. It's a steady sector, and there are opportunities both from the export as well as the domestic front. So, selectively, I think maybe this correction might give us an opportunity to increase our weightage there.
Right, so correction may give an opportunity to increase the weighted, but do you think the kind of selling that we've seen in the pharma sector in the recent time, that has been overdone?
I don't know, frankly, whether the selling is done or not, but selectively, I think, over the last couple of, years and also specifically last couple of quarters, we have reshuffled our pharma portfolio quite significantly. And as we speak, few large companies are now coming to, good or reasonable valuation levels. So maybe, in the next quarter or two, one might get an opportunity to really build a good long-term portfolio in the pharma space.
Right, so that was about the pharma pack. What's your view as far as the IT sector is concerned going forward?
So the large cap IT sector has done reasonably, not as well as some of the second tier IT stocks. There is a lot of interest in buying over mid-range smaller IT companies based in India by global IT majors. And I think that clearly points to the fact that there is definitely a moat as far as Indian IT services is concerned. The valuation of even the larger IT companies are trading in reasonable valuation. We personally believe that the concern that the segment might see very muted growth or degrowth in terms of volumes going forward because of increased digitization is a little bit far-fetched. We continue to be quite optimistic that there is a reasonable scope of growth. And again, with currency being stable to slightly weak, I think this is a sector which gives you free cash flow, is immune to cyclicality as far as the domestic economy is concerned. With the world also looking a little bit more reasonable and stable, specifically the US and the Euro region, backed by the QE tapering, backed by the QE in the Euro region, I think this sector is quite reasonable.
Okay, so that's two sectors that we wanted your thoughts on. That is pharma, IT. You're saying in pharma, the big falls that we've seen open up opportunities. You're not saying whether this is it, but you're saying it opens up opportunities. IT, you're saying concerns are overdone on volume growth, etc. You remain bullish. What are you really working on? Any big ideas, Sunil, that you are working with? I mean, don't have to be new ones, but in existing sectors, something has changed, which opens up possibilities for making a lot of money. Or could be new sectors, Sunil.
So, one interesting thing is that last Diwali and this Diwali has been so different. Last Diwali, the markets were expecting or presuming more than what the government was saying. And this Diwali, the market is just disregarding what the government has been saying and doing. So even if you see the last 8-10 days, announcements by the government, this have been really path-breaking announcements. FDI norms being eased in almost 15 sectors. The fungibility specifically on private banks as far as FD and FPI is concerned being removed. The concerns there being, sort of addressed. You have massive, again, path-breaking reforms in the power sector, where the power minister is on record saying that it will lead to almost 1.8 lakh crore savings every year. I think this has been disregarded by the market because, again, what has happened over the last 1 year in terms of walking the talk has not been to the satisfaction of the market, and now it's on the other way around. So we believe that utilities can become an exciting sector. Banking at some point of time, obviously there are concerns in a lot of banks, might become interesting. Cement as a sector, once the capex cycle from the government starts, can become quite interesting. So again, it's back to the domestic sectors. Consumption has been very muted till September. However, October numbers for two-wheelers, four-wheelers, even some of the consumption names like garments and malls and all have been quite buoyant. So it's early days, but there is optimism that the domestic sectors again would be worth looking, and more so with the kind of corrections which we have seen over the last 2-3 months in particular.
So utilities, which is power companies, you're talking about banking, and you're talking about cement, all domestic-facing sectors. Sunil, you mentioned the FDI reforms as being path-breaking. Can you identify one or two areas where you think there will be a fair bit of inflow and a fair bit of action because of the opening up of caps, the FDI caps?
So one is very clearly the bifurcation between FP and FDI in banks. It has been merged into one composite limit, and a lot of banks, some of the larger banks would see or would have room open for fresh flows to come in. Similarly, in the smaller realty projects, the norms of having a minimum size of the project or land has been done away with, and I think that sector definitely needs some capital, and maybe with this easing of the norms, not only capital can come in, but the sector itself can see some breathing space, and it should be good for even the banking space. So I think these two sectors, apart from the various other sectors which have been mentioned, are definitely worth noting.
Right. Sunil, specifically when we are talking about utilities, as you've mentioned that it's going to be an exciting sector going forward, are we specifically talking about NTPC?
So there are stable businesses which have a fixed ROE which they can earn. Now with falling interest rates, obviously one, their ROEs will go up, and second, the valuation for these kind of companies in a falling interest rate environment also goes up. So I think they are definitely worth now researching and looking at.
In the banking sector particularly, what are your thoughts as far as disruptions are concerned? Nandan Nilekani has also recently spoken about it. I'm actually trying to understand if at all do you see any big private banks really getting disrupted going forward?
So disruption is the order of the day. It's not only in banking, across businesses, disruption is happening, whether it is media, whether it is financials, whether it is retail, whether it is IT. So disruption is the order of the day, and forward-looking companies, irrespective of the sector, would brace themselves, would reorganize themselves, would look forward and compete with them. So I think even on the banking side, there are some forward-looking banks who have already started doing exceptionally well, even on the digital strategy, and those banks don't have to worry. But obviously banks who don't focus on the future would be the ones to lose market share. It's still going to be very gradual, but as I said, it's the order of the day, and you have to start looking forward, irrespective of the sector you're working in.
Right, and what's your view as far as the cement space is concerned? Though there was a lot of optimism around that, but do you think the situation as compared to last Diwali and this Diwali, it's gloomy at this point in time? Would you agree?
So again, without naming any companies, cement is a domestic sector. It does not get impacted by the global environment, unlike the metal space or the steel sector. Cement companies are operating at 65-70% capacity and still making decent margins. In fact, the operating margins for September quarter for all cement companies have surprised on the upside, led by huge savings on the power cost because of lower furnace oil as well as coal cost. A slight increase in government spending can increase their capacity to utilization and can lead to a huge operating and financial leverage. So as I said, it's a domestic sector. You can't import in bulk. And there are no new capacities of a large scale coming up. And there has been quite a lot of consolidation also over the last 2-3 years, where larger cement companies have been buying smaller cement plants from companies who don't want to spend more money or expand capacity there. So I think all the ingredients of a decent growth are visible there. Yes, the near-term growth environment is weak, as also the near-term, the pricing environment has not all been healthy. But as investors, you have to look in the future rather than look in the past.
Sunil, one last question before we wrap up. You do a lot of number crunching yourself. Has the underlying earnings momentum, whatever measure you look, whatever group of companies you look, has the earnings underlying momentum getting worse? Especially over the last couple of quarters? Or would you say, well, that's not really true, it's not improving, but it's not getting worse?
No, frankly, the last 2-3 quarter earnings have overall been disappointment. However, the silver lining in the September earnings were the quality of earnings. So the top line growth was very weak, led by shifting of the festive season by a month. Therefore, instead of September, The sales have started to come in October. Also, the inflation has been lower, so the value growth has been lower. And overall, the demand environment has been very, very bad. So top line growth for companies have been disappointing. However, the quality of earnings have improved because operating margins across have gone up significantly. So whether it's engineering companies, auto companies, cement companies, even some of the metal companies have reported good operating margins led by lower cost and lower power and transportation cost. So that makes us a little bit more, sort of optimist that once the top line growth comes back, the earnings might surprise. But very clearly a disclaimer, the last 2-3 quarter earnings have not been up to the mark.
Sunil, thank you very much for your time. Great speaking with you. And once again, from all of us here, wishing you a very, very happy Diwali.
Pleasure. Happy Diwali and thanks for having me.